Okay, now today we'll see the last method. So when I told you the valuation of shares, I told you the first method was net assets. We have done this. Under yield method, I have calculated problem on rate of dividend, rate of earnings and price earning ratio. So today we'll see productivity factor and fair value method. Chances of asking productivity is very less, or I will tell it is not at all asked in any of the question papers. So I will just give you the formula. You just know the formula. We will not solve any problem on the productivity factor. I will only give you the formula because it is not asked usually in the exam. The most important is a fair value method, which is a combination of net assets and yield value. So we'll do problem on fair value method. So today in this class, before I start with the fair value method, I will just give you the formula for productivity. So I'm going to call this as, now this is a third main method. Okay. Under your yield method, this is a third main method. So valuation based on productivity factor. Okay. Now this productivity factor, when you write, it is given by the formula average weighted adjusted taxed profit divided by average weighted net worth into 100. Okay. Now you have formula for even these two. Therefore, your average weighted adjusted taxed profit is given by the formula total product divided by total weights. Okay. When I tell total product, what I mean here is your average taxed profit into number of weights. This is called as your total product divided by total weights. Average net worth, average weighted net worth. Average weighted net worth is given by the formula total product divided by total weights. So when I tell total product here, I mean is average net worth into number of weights. Okay, just know the formula. Usually it is not asked in the exam, but I've just given you the formula how to calculate your valuation of share under productivity factor. So we take the profit, which is average of your weighted adjusted taxed profit divided by the net worth. Net worth means your share capital into 100. Again, your average weighted adjusted profit is total product divided by total weights. When I tell total products, I mean here is average taxed profit multiplied by number of weights. That is 1, 2, 3, 4. These are called as weights. Average weighted net worth is total product divided by total weights. The same formula, but the difference here is total product is the average net worth into number of weights. Okay, all the information will be there in the question, but they don't ask this method in the exam. What they usually ask is the last method, that is a third main method under the valuation of share, which we call it as fair valuation method. Okay, this fair valuation method or the fair value method is given by the formula valuation of share is equal to intrinsic value plus yield value divided by 2. So both together means basically the average of your intrinsic and yield value will give you the answer for fair value method. When I write yield value, your question will be which formula should I use? Rate of dividend or rate of earnings or price earning ratio. So usually the question will give you on rate of earnings. So we will have to do yield value under rate of earnings. If not, it depends on the question. If they have given you price earning, then we have to use price earning ratio. If they have given you rate of dividend, then we have to use rate of dividend. But most of the time it is rate of earnings. So this is a formula for it. Keeping this formula in mind will solve the problem. So we have already done intrinsic value method. We have already done yield value method also. So it becomes easy for you. I will just read the question and then we'll do one by one. The following is the balance sheet of Bharat Limited as on 31st March 2015. You have share capital, reserves and surplus and creditors. And then under non-current assets, we have tangible fixed assets, intangible fixed assets which is patent and trademark, stock, debtors and bank. 1000 equity shares of 100 each, 1 lakh. General reserve 20,000. Preliminary expense 6,000. Profit and loss account which is a surplus 16,000. Tangible fixed assets are your land and building, plant and machinery. Now please read this carefully. The exporter valuer valued land and building at 1,20,000, goodwill at 80, plant and machinery at 60. So these are nothing but the market value. Depreciation is charged on building at 10%, plant and machinery at 5%. Out of the total debtors of 4,000 remained bad. Means out of your total debtors which is given to be 44,000, 4,000 are your bad debts. Means you know that 4,000 definitely you will not receive from the debtors. So it is considered like a loss only. The profits of the company is given for 3 years. The company follows a practice of transferring 20% of the profit to general reserve. Similar type of company earns 10% value on their shares. You are ascertained to calculate the company's share under intrinsic value, yield value and fair value. Ignore income tax. So obviously if you do these two methods, then fair value is easy. So each information you require, means one set of information you require for net asset method or the intrinsic value method. The other set of information, if you see here, this information is required for yield method. So first we'll do intrinsic value. Intrinsic value is nothing but your net asset method, if you remember. So under your net asset method, how do you value the share? Value of share is equal to net assets available to equity shareholder divided by number of equity shares. So this is what we have been doing for the net asset method. So first we have to write all the assets which is given in the problem. So we'll first write the market value of the asset and then we'll write the book value. So the first market value which is given is land and building, 1,20,000. Then you have plant and machinery, 60,000. So you have the market value for these. Then you have goodwill, 80,000. This is again a market value which is given. Okay, 80,000. Then you have patent and trademark, 10,000. So I consider only the book value because there is no market value for patent. Then I write stock which is 24,000. Again stock is a book value that I have written. Then debtors. Please remember debtors is 44,000. They have told 4,000 are my bad debts. Means 4,000 I know I will definitely not receive. So when I consider, I am going to consider only 40,000 because 4,000 are my bad debts. Then on your assets we have bank which is 26,000. Okay, take the total of all this. you get 3,60,000 as my total assets. Okay, from which I should minus the outside liability and preference share capital also. Okay, now in the question you don't have preference share capital, you have only one outside liability, which is your creditors. Rest of the information is not given. So creditors directly I am going to minus 94,000, so that I get 2,66,000. So this 2,66,000 is my net assets available to equity shareholders. So coming back to the formula, 2,66,000 divided by number of equity shares. They have told you 1,000 equity shares of 100 each. So number of equity shares is 1,000. So under your net asset method, your value per share is rupees 266. So intrinsic value is done. The next method that they are asking you to find out is a yield method. Okay. Now please concentrate for yield method. Now the big question that you will all have is, what method should I follow under yield? Okay. Now if you just read the question, see here they have given you one sentence wherein similar type of companies earn 10% on the value of their shares. Earn 10%, so we all know it is rate of earnings, or you can take even rate of dividend also, because for both the methods it is the same formula only, but usually we follow rate of earnings. Okay, so under yield method, value of your share is given by the formula paid up value per share into expected rate of earnings divided by normal rate of earnings. Therefore, expected rate of earnings is equal to profit available to equity shareholders divided by paid up equity share capital into 100. So this is a formula that we have been following. So according to the formula, we should first find out how much is a profit available. Okay. Now if you see in this problem, you don't have 1 year's profit. Rather, the question has given you profit for almost, you have profit for 3 years. Okay, you don't have profit for 1 year, you have profit for 3 years. Whenever you have the profit for 3 years given, we will take the total of all the 3 years profit and then we do the problem. Okay, so what I'm going to do is, first I'm going to write total profit. When I tell total profit, I mean is all 3 years profit. Okay, so the total profit of all 3 years is 1,24,000. That is 42,000 plus 35,000 plus 47,000 will give you 1,24,000. Okay, this is the total profit. From this, remember, I should minus one concept which is called bad debts, because this bad debts I know definitely I'm not going to receive. So when I'm not going to receive, it will directly affect my profit. So from 1,24,000 my profit will come down to 1,20,000. Please keep this in mind. Okay, remember, we are taking the total profit of all the 3 years, from which I am minusing only the bad debts which have got 1,22,000. Now this 1,22,000 is for all 3 years. So how will I go ahead with the problem? I will first have to take the average annual profit. How will you calculate your average annual profit? 1,20,000 divided by profit is given for 3 years. So my average annual profit is 40,000. Why did I find out average annual profit? Because on this average annual profit only I am going to make certain adjustments. So average annual profit is 40,000, from which I am first going to do the adjustment for depreciation. Why depreciation? Because under your net asset method, we have not considered the depreciation. We have considered only the amount that has increased and decreased. But we have forgotten the depreciation. Means depreciation is not shown in the net assets method because it is shown in the yield method. See, they have told you depreciation is charged on buildings at 10%. Plant and machinery at 15%. So definitely this is going to affect my profit. That is why it is shown under your yield method. So first let me do the depreciation on land and building. Okay, now land and building market value was 1,20,000. Book value means the balance sheet value of your land and building was only 55,000. So if you see, the land and building value has been increased. So whenever the value has increased, we have minus the depreciation. Okay, so the depreciation amount is 1,20,000 minus 55,000. You will get 65,000. So 65,000 into percentage mentioned is 10%. So 65,000 into 10% is 6,500 depreciation for land and building. Similarly, we'll do depreciation on plant and machinery. Plant and machinery, the market value given is 60,000. Okay. The book value of plant and machinery was 65,000. So if you see, from 65,000 the market value is 60,000, so it has been decreased. So whenever the value is decreasing, we add the depreciation. Okay, the concept is simple. If your market value is greater than book value, we minus the depreciation. If your market value is less than the book value, we add the depreciation. So here the difference between these two is 5,000. Depreciation rate mentioned is 15%. So 5,000, 15% will give you 750. This should be added. So when you do your adjustment here, you get 34,250. Now this is not the total profit, okay, because you have further adjustment. What is the further adjustment after this? See here in the last line they have told you, the company follows a practice of transferring 20% of the profit to general reserve. So after doing all this, I will minus transfer to general reserve, which is 20%. So 20% of 34,250, you get 6,850. So now when you minus these two, you will get 27,400. This 27,400, this will be called as your profit available to equity shareholders. Okay, so this is how you have to do. Now you have found out, so now let us substitute in the formula. So profit available is 27,400 divided by paid up value of equity share capital given in the question is 1 lakh. So 27,400 into 1 lakh, divided by 1 lakh into 100 will give you 27.4. Okay, so we'll come back to the main formula. Paid up value per share means value of one equity share given is 100 into expected rate of earning is 27.4 divided by normal rate of earnings in the given question is 10, which we have already underlined. So 27.4 into 100 divided by 10, the value of your share is rupees 274. Okay, this is the value of your share under yield method. So therefore your value of share under your fair value, okay, C they have asked was fair value. which is nothing but IV plus YV divided by 2. So intrinsic value which we had got was 266 plus yield value is 274, the whole divided by 2, so your fair value is 270. Okay, it is just an average of first two methods. So this is how you have to do your problem under fair value. So you should know what items to be considered under your intrinsic value and what items to be considered under yield value. Then only you will be able to identify the fair value clearly. Okay.